This pattern has caused some of the biggest reversals in trading, but most traders will miss the signal. It's called the head and shoulders. Hi, my name's Ian Coleman and I'm a senior analyst at FXStreet. I want to discuss with you how to spot and, more importantly, how to trade a reversal pattern known as a head and shoulders. We will also highlight some pro tips in this video, so keep watching until the end. The head and shoulders formation is one of the most reliable and recognizable patterns in technical analysis. It signals a potential trend reversal, especially after an extended bullish run. Let's break this pattern down. First, we have the left shoulder. So price rallies and then pulls back. This creates the first peak and is followed by a retracement. It shows that buyers are still in control, but we see signs of profit taking. Second, we have the head. Now this needs to be the highest peak. Price moves up, making a higher high. From here, we will often dip lower, close to the previous pullback area. Third, we have the right shoulder. We see the third rally, but this time buyers failed to reach the height of the head. This is a clear signal that bullish pressure is weakening and the market begins to fall. We have spotted the structure, so how do we trade this pattern? Now the fourth component is known as the neckline. We draw a line between the two swing lows that connect the bottom of the left shoulder and the head. Now this is a very critical level. A break below here confirms the pattern. This usually signals the start of a downtrend, and traders will often enter short positions here. The measured move target is calculated by taking the length from the head to the neckline and then projecting that from the breakout level. The hard part has been achieved. We've spotted the pattern. Now we need to calculate our risk to reward factor. We know our entry level, we know our target level, but where do we place our stop loss? Now it's common practice to place this protection trade back inside the breakout level. We should be looking for a minimum risk reward factor of around about 2. This is a calculation on how much you can expect to gain from executing this trade. A risk reward factor of 2 denotes that for every unit you risk, you should expect to get 2 back. In this scenario, we calculate the risk reward factor to be around about 3. The head and shoulders pattern. Why does this formation often work? Well, let's discuss the market psychology. So the left shoulder, buyers are still dominating price action. They're feeling pretty comfortable, but they do meet with some resistance. Okay, this could be seen as a profit-taking correction. The head, buyers make a final strong attempt, but they cannot sustain the rally. The right shoulder, that highlights a change of trend. There's only a few buyers that remain and sellers gain a foothold. And then we have the breakout. Now this is a decisive change in momentum and stops are triggered to the downside. All of this information can be applied to the opposite pattern. This is known as a bullish reverse head and shoulders formation and signals a positive reversal. Let's move on to the pro tips section. Pro tip number 1. We've already discussed how the head and shoulders formation is more powerful if it's seen at the top of a trend. Now the relative strength indicator or the MACD should be reading at overbought extremes. If the oscillator you are tracking makes a lower high while the asset makes the head or a higher high, then this is known as bearish divergence, and it's a clear indication that momentum is failing. And pro tip number 2, spotting a change of trend is one of the biggest challenges for newbie traders. The Elliott wave theory could help you out with this. The Elliott wave theory highlights that the markets move in predictable waves. We have a 5-wave structure followed by a 3-wave correction. Now, the head and shoulders formation will often make up the left shoulder, the head, the right shoulder, and also the ABC correction. And the third pro tip, you can sometimes combine the head and shoulders with another pattern. Bull runs will often finish with an ending wedge formation. The peak inside this pattern can be seen as the head. A retest of the breakout level can be noted as the right shoulder, and this sometimes offers an opportunity to sell into the head and shoulders formation ahead of the neckline break. So that's how to spot and trade the head and shoulders formation. Which technical pattern would you like us to cover next? Drop it in the comments.